The world has not seen a situation like this for decades, a moment when a single metal becomes simultaneously a strategic industrial resource, a quiet reserve asset for governments, and an object of discrete accumulation by major corporations. Today, silver has reached exactly that point. It has moved from being considered the second precious metal to becoming a critically important raw material whose shortage can no longer be ignored. And everything happening on the market right now signals one thing. The fundamental imbalance between supply and demand is becoming irreversible. Let's begin with the facts. Silver is not gold. It does not sit untouched in vaults. It does not gather dust in bank storage rooms. More than half of all silver mined each year is consumed by industry, and especially by industries where silver simply cannot be replaced. Electronics, solar panels, medical devices, military technology, battery systems, high-efficiency connectors. Silver's unparalleled conductivity and thermal properties make it essential to modern technological infrastructure. These sectors must use silver regardless of price, regardless of market cycles, and regardless of geopolitical conditions. But here's the paradox. Demand continues to rise, but supply does not. Silver production has barely grown in recent years, and in some regions it has even declined. New major deposits are not being discovered, while existing mines are being depleted faster than they were a decade or two ago. Most silver is not mined independently. It is produced as a byproduct of mining lead, copper, and zinc. This means the volume of silver entering the market does not respond to silver prices at all. Even if silver doubles or triples in value, mining companies cannot accelerate production unless the primary metals they extract also experience a boom. Meanwhile, industry is consuming everything that comes onto the market. The solar energy sector has expanded so dramatically that analysts now refer to it as a silver vacuum cleaner. Every solar panel requires silver, and the faster nations transition to renewable energy, the more silver is absorbed. Current forecasts show that in the near future the solar sector alone may consume up to 25% of the world's annual silver supply, while all other industries continue demanding just as much as before. Add to this the surge in investment demand, triggered by global uncertainty and distrust in fiat currencies. Add declining inventories on major metal exchanges, where available physical silver continues to shrink year after year. Then imagine rising global demand stacked against stagnant production. This is the textbook definition of a structural shortage, a market that cannot rebalance at any price level. When this happens, analysts say the market enters a structural price breakout, where short-term volatility may occur, but the long-term direction becomes unmistakable, upward. This is why more and more experts argue that silver is entering a period of global lockdown. The metal is disappearing from the open market. It isn't just becoming more expensive. It is being removed from circulation and concentrated in the hands of those who plan to hold it for years. If current trends continue, the world will soon face not just higher prices, but a real physical shortage capable of reshaping entire industries. For decades, silver was treated as a secondary asset, useful, valuable, but far from the strategic status of gold. Central banks openly accumulated gold, reported their holdings, and used it as a foundation of monetary confidence. Silver, meanwhile, drifted in the background. But that era is ending. Today, governments and state institutions are quietly returning to silver, not for symbolic reasons, but because the global economic landscape is changing faster than anyone predicted. The first sign of this shift is the changing role of silver in national resource strategies. As countries push aggressively toward renewable energy, electrification, advanced weaponry, and high-density battery storage, silver becomes a core ingredient of state-level industrial planning. A country cannot build next-generation solar fields, autonomous weapons, high-speed communication systems, or resilient electrical grids without a reliable supply of silver. And unlike copper or nickel, silver's properties cannot be replicated or substituted at scale. Governments understand that future technological independence depends on having enough of this metal. This is why several nations are now expanding their strategic reserves, often without public announcements. Unlike gold purchases, which are widely reported and sometimes even politicized, silver accumulation is happening quietly, through state-affiliated industrial buyers and sovereign entities that do not disclose detailed inventory data. In practice, this means physical silver is being removed from the open market and transferred into long-term national stockpiles. Another factor driving the shift is the weakening trust in global financial systems. As debt levels rise and geopolitical tensions intensify, governments are looking for assets that have both industrial necessity and monetary reliability. Silver fits uniquely into both categories. It is simultaneously a critical component for future technology and a historical store of value during crises. In other words, silver is not just a metal, it is insurance. There is also a growing recognition that silver remains dramatically undervalued relative to gold. The gold-to-silver ratio, historically around 15:1, has hovered between 70 and 90 for years, a signal to many policymakers and analysts that silver is mispriced. This creates a rare opportunity for countries seeking to diversify reserves at a discount. Some experts believe that if silver's monetary role returns even partially to its historical average, the ratio could collapse, triggering a rapid revaluation of the metal. Finally, the trend is fueled by scarcity itself. Governments see the same data analysts do. Industrial demand is rising, mining supply is stagnant, and physical inventories are declining. If these lines continue to diverge, silver could become strategically scarce. No state can afford to face that risk in the coming decade. What makes this moment remarkable is not that governments are buying silver. It is that they are doing so quietly. They are not trying to influence the market. They are not making political statements. They are preparing. They are positioning themselves for a future in which silver is no longer an abundant industrial commodity, but a strategic asset with enormous geopolitical implications. The public will only realize the scale of these accumulations when the shortage becomes undeniable. By then, the price will no longer be within reach for most investors, and the governments that acted early will already have secured their advantage. The most alarming development in the silver market today is not the rising price or the growing industrial demand. It is the silent disappearance of physical metal, a phenomenon that analysts have begun calling the global silver lockdown. This is not a metaphor. Around the world, investment-grade silver is being withdrawn from public circulation and transferred into private vaults, government reserves, and long-term industrial storage. And what makes this trend so powerful is that it is happening quietly, without headlines, without announcements, and without the general public noticing. The first signs appeared on major exchanges. Warehouses in New York, London, and Shanghai, traditionally the backbone of global silver liquidity, began reporting year-over-year declines in their registered stocks. At first, the numbers seemed insignificant. A few percentage points here, a few tons there. But over time, the pattern became impossible to ignore. Each month showed lower inventories than the month before, and the flow of metal leaving vaults consistently outweighed the amount entering them. This is a critical warning signal. When physical inventories fall during periods of rising demand, the market enters a stress zone. For silver, a metal already facing structural shortages, this stress becomes multiplied. Investors who want physical silver increasingly struggle to find it in the form of bars and coins. Delays grow longer. Premiums rise. Retail shelves that once held hundreds of products now sit half-empty. And yet the price on paper markets often lags behind these realities, creating a widening gap between physical and synthetic markets. The second force behind the silver lockdown is industrial lockdown. Corporations are securing long-term contracts to ensure supply for the next 5 to 10 years. Solar manufacturers, electronics giants, and defense contractors are no longer comfortable relying on spot markets. They are reserving physical metal directly from miners and refiners, removing those volumes from future public availability. Every ounce locked into a long-term industrial contract is an ounce that will not re-enter circulation for decades. But perhaps the most striking part of this phenomenon is the behavior of high-net-worth individuals and private funds. Quietly, without public statements, they are accumulating physical silver at unprecedented levels. For years, gold was the preferred hedge for wealth preservation. Today, silver is becoming the silent alternative, less noticed, less regulated, and still dramatically undervalued. Vaulting facilities around the world report increases in private silver storage, often outpacing gold on a percentage basis. These holdings do not appear in official statistics, making the true scale of the lockdown even more dramatic. When governments, industries, and wealthy investors simultaneously remove silver from circulation, the effect is exponential. The market becomes starved of physical supply. Prices may move slowly at first, but availability collapses far more quickly than the charts suggest. And this is exactly what we are beginning to see. For ordinary investors, acquiring physical silver is becoming harder every year. For institutions, forward planning is becoming an urgent necessity. And for governments, the disappearance of silver is a strategic warning. The world is entering an era where this metal can no longer be treated as abundant. The global silver lockdown is not a temporary phase. It is a structural transition. The metal is being absorbed into systems, industries, and vaults that will not release it back onto the market. And when the full impact becomes visible, the price will simply adjust to a new reality, one where scarcity is the defining feature of silver's value. If the global silver shortage were visible on charts, the world would already be in panic mode. Prices would be soaring, inventories collapsing, and investors rushing to secure whatever physical metal remained. But that is not what we see, at least not on the surface. Instead, the silver price often moves sluggishly, disconnected from industrial consumption, disconnected from falling inventories, and disconnected from reality. This disconnect exists because the silver market we see is not the silver market that actually matters. It is a paper market, a synthetic system engineered to create the illusion of abundance while physical metal quietly vanishes. To understand this illusion, we must look at how modern commodity markets operate. Most silver transactions today do not involve real bars, real coins, or even real ounces. They are paper contracts, futures, derivatives, unallocated accounts, and ETFs that promise silver without requiring anyone to actually possess it. These instruments multiply the supply of silver far beyond what physically exists. In some years, the paper claims to silver exceed the amount of real metal available by more than 100 to 1. In other words, for every ounce of silver in a vault, dozens, sometimes hundreds, of people believe they own it. This system works only under one assumption, that almost no one will ever demand physical delivery. As long as investors are content with digital ownership, the illusion holds. The price remains controlled, volatility stays manageable, and the market appears balanced. But the moment physical demand increases, when investors want real silver, not paper promises, the system becomes strained. Delivery delays grow. Premiums rise. Contracts are rolled over instead of fulfilled. And the true scale of the shortage begins to surface. This tension between paper silver and physical silver is the core of what analysts call manipulation. It is not that prices are artificially set by a single entity. It is that the structure of the market itself suppresses price signals. When hundreds of millions of synthetic ounces flood the market, they dilute the impact of real supply and real demand. As a result, even when inventories fall to multi-year lows, the price may barely react. The paper market absorbs the shock, masking the reality underneath. Meanwhile, industries that need physical silver cannot use paper contracts to build solar panels, semiconductors, or precision-guided weapon systems. They need real metal, and they compete fiercely for it. As industrial offtake grows and inventories shrink, this competition intensifies. Yet the price remains anchored by paper markets that do not feel the same pressure. This is why many analysts now argue that the paper-silver system is approaching a breaking point. The mismatch between synthetic silver and physical silver has grown too large. The physical market is tightening at a pace the paper market can no longer ignore. If a major industrial consumer, sovereign wealth fund, or institutional investor demands substantial physical delivery, the system could be forced to reveal its true condition, exposing a scarcity far more severe than current prices suggest. The key risk is simple. The paper market can promise silver endlessly, but it cannot produce it. When the holders of those promises decide they want the real metal, or when geopolitical or industrial shocks make physical silver the only acceptable form of ownership, the illusion collapses. At that moment, the price will not rise gradually. It will reprice violently, adjusting to years of artificially suppressed demand and underestimated scarcity. For now, the illusion remains intact. But the gap between paper and physical silver widens every year. And once the market is forced to reconcile the difference, the revaluation could become one of the most dramatic events in modern financial history. The most important question is not whether silver is becoming scarce. That is already happening. The real question is what this scarcity means for the world, for investors, for industries, for ordinary people who never imagined that a single metal could influence their daily lives. The answer is simple. A global silver shortage does not just affect financial markets. It reshapes economies, disrupts technologies, and triggers consequences far beyond the investment world. First, let's talk about investors. For decades, silver has been treated as a speculative side asset, overshadowed by gold and often ignored by institutional buyers. But as physical metal disappears from circulation, this perception is changing. Investors seeking real silver, not paper promises, are beginning to find that it is no longer easily available. Premiums are rising, delivery times are stretching, and at some point, the market will reach a moment when demand overwhelms supply, creating a repricing event similar to what happened with other critical commodities in tight markets. This shift will catch many by surprise. Most people assume they will always be able to buy silver at the market price. But the truth is that when a commodity becomes structurally scarce, the market price is no longer the real price. The real price is whatever someone is willing to accept in exchange for physical metal, and that number may be far higher than anything displayed on a trading screen. For industries, the consequences are even more dramatic. Silver is essential for modern civilization. Without it, solar panels lose efficiency. Electronics fail to function properly. Medical equipment becomes less reliable. Military systems lose precision. And because silver cannot be substituted in most of these applications, industries cannot simply switch to another material. They must compete for what remains. This competition creates a new hierarchy in the silver market. Governments and major corporations are at the top, securing long-term contracts and buying in bulk. Retail investors are in the middle, fighting for limited supply at ever-increasing premiums. Ordinary consumers are at the bottom, experiencing the hidden effects of the shortage through higher prices for electronics, renewable energy systems, and medical devices. But perhaps the most profound impact will be psychological. For decades, people believed that silver, like most commodities, would always be available. It was simply part of the economic background. But the silver market is now revealing a truth that modern society has forgotten. Critical resources do not remain cheap and abundant forever. When demand outpaces supply, when governments and industries absorb everything they can find, and when physical inventories approach exhaustion, scarcity becomes reality. This is where the concept of the global silver lockdown becomes more than a market trend. It becomes a structural shift in how the world operates. Silver is not merely an investment or a raw material. It is infrastructure. It is energy. It is medicine. It is technology. And when a resource this central becomes scarce, the effects ripple across every sector of the global economy. For individuals who understand what is happening now, this moment represents a rare inflection point, a chance to prepare before the rest of the world wakes up. For those who ignore the signals, the coming years may bring a level of price shock and scarcity that feels sudden, unexpected, and irreversible. The silver market is not moving toward instability. It is already there. And the deeper the shortage becomes, the more dramatic the consequences will be for economies, industries, and the lives of ordinary people around the world.